It is July 2026, and the artificial intelligence industry has officially moved beyond the research lab. The focus has shifted from model benchmarks to the largest financial battlefield in modern history. To understand why this shift happened so suddenly, we have to look toward the aerospace sector, and specifically toward Elon Musk. For years, investment firms questioned if the public markets could absorb a trillion-dollar debut. On June 12th, SpaceX answered that question by going public with a valuation of roughly $1.75 trillion. This chart tracks the immediate volatility that followed. The stock debuted at 225, but plummeted to 153 in a rocky post-IPO correction. Even with that drop, institutional and retail investors bought the offering in its entirety. The market absorbed the volume without flinching, which removed the psychological barrier for other mega-cap tech firms. Seeing that the window for a trillion-dollar debut was open, the boards at Anthropic and OpenAI immediately moved to file their own confidential prospectuses. In early June 2026, OpenAI and Anthropic filed their S1 drafts just 1 week apart. They started from the same point, but their strategies have diverged into two completely different paths. Both companies are now chasing a public valuation at or above the $1 trillion mark. This presents a specific dilemma for tech leaders and investors. You have to choose which ecosystem to support, yet their financial architectures have almost nothing in common. To determine which platform is a sustainable reality and which is a long-term frontier bet, we have to look past the branding and analyze the leaked financial math. Anthropic is currently in a relentless sprint. Their strategy focuses almost exclusively on immediate enterprise monetization. In late May 2026, they closed a $65 billion Series H round. This gave them a private valuation of $965 billion, briefly making them more valuable than OpenAI on paper. That valuation is supported by the rapid adoption of Claude Code. This agent has integrated into corporate developer workflows, driving massive revenue growth. This chart shows the scale of that growth. Their annual recurring revenue rose from $9 billion at the end of 2024 to a staggering $47 billion by May 2026. On July 1st, the U.S. Commerce Department lifted strict export controls on Anthropic's most advanced models. This regulatory win removed the primary obstacle for international expansion, clearing the way for their planned public debut this October. By focusing on enterprise utility over consumer brand dominance, Anthropic has secured a predictable path to reaching cash flow break-even by 2028. OpenAI is operating on a different timeline. They are running a high-friction marathon that requires significantly more capital. CEO Sam Altman holds firm on a minimum $1 trillion valuation for an IPO, though leadership is now considering pushing their listing into 2027. Their top-line revenue is strong, with an early 2026 run rate of $25 billion. However, that revenue is offset by the massive compute and training costs required to pursue artificial general intelligence. These leaked projections show the reality of the AGI burn rate. Their $25 billion revenue is swallowed by training costs, leading to GAAP losses of up to $26 billion for 2026. This high infrastructure spend means OpenAI is not projected to reach true profitability until 2029 or 2030. OpenAI operates as a high-risk infrastructure fund, asking the market to finance years of heavy losses in exchange for the long-term potential of AGI. When you place these two companies side by side, the math reveals a major discrepancy in how they are being priced. This matrix breaks down valuation multiples. Anthropic's $47 billion revenue yields a 20x multiple, while OpenAI requires a 34x multiple. Since Anthropic debuts first, they establish the baseline. Their assigned multiple becomes the formula used to price OpenAI in 2027. This has created intense friction behind the scenes, particularly because both companies are represented by the same lead banks, Goldman Sachs and Morgan Stanley. Waiting until 2027, OpenAI will no longer be priced on hype alone. They will be strictly measured against the financial precedent Anthropic sets this year. To decide which ecosystem to back, you have to align your choice with your own risk tolerance and time horizon. We map these paths on a quadrant chart, comparing time horizon against capital risk and burn. Anthropic occupies the bottom left quadrant as a stable, highly monetized software provider. OpenAI sits in the extreme top right, representing a long-term research bet with significantly higher capital requirements. Choosing between them involves deciding whether you value immediate software margins or the long-term development of frontier infrastructure. If you prioritize stable, regulatory-cleared tools and predictable software margins today, the math points towards Anthropic. If you believe AGI will eventually restructure the economy and you have a multi-year horizon, OpenAI is the primary vehicle for that bet. However, backing the frontier path means you must be prepared for years of heavy financial losses and significant stock volatility. As these companies move on to the public exchange, their internal balance sheets will be held to a transparent standard. The market is finally going to put a concrete price on the pursuit of AGI.